we're here to welcome Denise Shull and heartily welcome her and her attribute to today's happening. And actually, before she begins, I would like to ask Janet Falk, who did that wonderful article for her in The Wire, since she has firsthand knowledge and can fill you in on details of Denise much better than I would like to ask her to speak. Thank you.
Thank you, Barbara. It's always a pleasure to be here at Gallery RIVAA. This is a unique opportunity to blend together the arts, psychology, the economics, mathematics, and find out what really drives our decision-making process. I got to know Denise through RIVAA and the Common Council and the activities that took place about 7 months ago regarding the protest outside Governor Cuomo's office. And so it's been my pleasure to work with her and introduce her to some news media so that she could tell her story. She's going to call to our attention what it is that influences us in terms of our past, our family relationships, our way of perceiving the world, and how that equips us to make our decisions. And after she speaks, there'll be an opportunity to ask her a few questions, and of course, to have the opportunity to buy Market Mind Games. And as we see, a radical psychology of investing, trading, and risk. So I'm very pleased to welcome Denise Shull, member of RIVAA Common Council, representing the Octagon. Denise.
Thank you so much, Janet, and thank you all for being here. I'm so pleased. I actually wasn't quite sure what to expect on a cold Sunday afternoon in February, but I'm pleased that you're here, and hopefully I will make it worth your while. This book, while it's called Market Mind Games, is really effectively a book about our perception, judgment, and decision-making, both what we know consciously and what's going on unconsciously to influence our perception, judgment, and decision-making. And essentially, it's a compilation of my, well, way too many years now, experience first as a neuroscientist studying neuroscience of the unconscious at the University of Chicago. And I got diverted from finishing my PhD because, for those of you who may know, Chicago is a very big trading town, and there used to be lots of trading floors in Chicago. And I happened to play volleyball with a number of guys who went down there all the time and did this and this and this. And they thought that I should come to the floor and trade with them. And I didn't see doing this and this with those guys. But as I was finishing my master's, writing my master's thesis, about to go to my PhD, they were some of the first traders to do what was then called go upstairs. So prior to that, everybody was in the pit looking at each other, making trades with each other, and networks where you could see what the price data were that were outside of the floor were really just beginning to be available inside the trading buildings. I mean, it was 1993, 1994, so there was an internet out there, but I mean, there was not the kind of price information that if any of you all actually had your own investing accounts. I mean, you couldn't get that kind of information away from the floor. So they said, oh, you're just writing that master's thesis, why don't you come keep track of our trades during the day, because you also couldn't get, as you can now, I mean, if you're any sort of trader, you know what your profit and loss is every nanosecond, but you certainly couldn't get that then, and we'll teach you how to trade. So sure enough, they were right. I did have some sort of knack for it, but that knack was a little bit, or I guess quite actually inexplicable, because while I managed to eke out an A in probability at the University of Chicago, it was only because I spent an entire summer doing nothing but working on probability. But yet I had this talent in reading the markets. And one of the studies that I refer to in the book is a study that came out of Caltech. Let's see now, it's been 3 or 4 years ago. It was just published last year. But it basically showed that if you understand the markets for what they really are, which is people's perception. I mean, in reality, in the financial markets, there are no facts. I mean, there may be a fact for some 1/1,000,000th of a second, and we have a quant back here in the audience who understands how the systematic quantitative trading that's going. There may be a fact for 1/1,000,000th of a second where something trades at that number, but really markets are rolling perceptions of what people around the world collectively think something should be worth. So should Apple stock be worth $500? But what the study showed was that you can look at it and try to understand it mathematically and through whether the company's going to earn more money or what, for those of you who are not that familiar with the markets, there's a whole group of people who do what's called technical analysis, look at charts. You can try to understand it through a chart, or you can try to understand it by predicting what other people are going to do. In other words, you say to yourself, okay, Apple is worth $450 today. If I buy it at $450 today, what's going to make my neighbor, what's going to make the guys on Long Island, what's going to make other people that I relate to pay $550 for it next year when I want to sell it at $550? The point of that study was people who used the parts of their brain that had to do with predicting other people's behavior actually turned out to be more talented at predicting markets than people who were using just numbers and probability. And so number one, that explained why I was good at it. It's called theory of mind. If you're a neuroscientist or a psychologist, it's called theory of mind. We have a theory of the other person's mind. We all have the ability to do theory of mind. I mean, we're born with it. We have to use theory of mind just to sit down in the chairs in here because you're making sure you're not knocking somebody else over, you're not knocking their glass of wine out of their hand. But that using the skill that we all have, theory of mind, and always asking questions, at least in a market realm, and I'll get easily past the market realm, made you better at understanding what markets were going to do. And for the, if it's fair to say, for the person who's not a market professional, which reminds me, I should ask, how many market professionals do I actually have in the audience? I see 3. Do I have more than 3? Do I have 4? I see 4. Okay, I see 4. For the person who's not a market professional, realizing that all of that stuff that's on CNBC or all of that stuff that's in the Wall Street Journal, that those, and then this actually applies to market professionals also, it's been shown from a neurological brain science point of view that if you use those numerical items of information as clues to answer the question, what's the other guy going to do? What's going to make him pay more for this stock? Or let's say, let's go back 3 years when the markets were falling apart and everybody was scared they were going to lose every penny that they'd ever saved. If I sell today, why is somebody going to sell at a lower price? And just taking a step back and understanding any investing decisions that you make in terms of other people is something that you all can do and has been shown actually is very effective. And if you think about it, I know the average person tends to be a bit afraid of the markets and think, okay, I got to give it to the experts because there's no way that I'm going to understand all of that and no way that I'm going to be able to choose what I should be doing. But I'm saying to you that just is simply in understanding even a part of your investing money in terms of other people, play with it a little bit. Play with keeping track of Apple stock, for example, or Google stock, or something, or another company that you're familiar with and that you like, one of the retail companies. And watch it over time and think, well, why should it be going up or why should it be going down? And you'd be surprised, actually, what you're able to come up with when you thought you could only leave that to the experts. Now, having said that, this is, like I said, it's a book about perception, judgment, and decision making. And what's conventional wisdom about judgment and decision making? There's a saying that's always in the market, that people that are market people always say, people maybe who aren't so much market people will talk about it, but it's not as obvious, and that is control your emotion. Well, at the core of why I wrote this book was because in 2003, so I became a trader then for a long time, and neuroscience and psychoanalysis were my hobby, and I thought that I would be trading forever. But in 2003, I had an opportunity to rewrite my master's thesis for publication for an academic journal, And in the interim decade, from when I had originally written it, there was voluminous human data proving without a shadow of doubt that you have to have emotion to make a decision. You can't decide what to wear, you can't decide what cereal to buy, you can't decide to go right or left, you can't decide what time to have an appointment. There's no debate about this amongst the neuroscience community. Now, in finance and on Wall Street, most people think, they still say, take the emotion out of it. So, but I was like, well, wait a minute. You have to have emotion to make a decision, but yet the conventional wisdom is you have to take emotion out of it. So, like, which is it? Or how do you bring the two together? And the bottom line is that you have emotion in all of your decisions, whether you know it or not. So what I do and outline in the book is I outline the science that shows you that then turns emotion into, instead of something that's negative or a liability, that it's something that you can actually use as information and data. Because if you think about it, what we've done logically is we have merged emotions with actions. In reality, I mean, it's a fact. In reality, all you have to do is choose or control the action that you take. You can feel whatever you want. I mean, a feeling is just a feeling. You can sit and feel a feeling, or you can jump up and down and feel a feeling, or you can pound a pillow, or you can, preferably not yell at somebody, but you don't actually have to do anything with a feeling. But standard psychology and sort of culturally, we've merged feelings and emotions and actions. The trick to perceiving anything, and making better judgment calls is separating those two and understanding what your conscious emotions and your unconscious emotions are telling you and why they're telling you that. So that the ultimate place that you're going, the ultimate question is you want to be able to know. And it doesn't matter whether it's, whether it's buying, whether it's being a trader, being an investor, whether it's buying a home, whether it's deciding to move across country, whether it's deciding to get married. I mean, it really doesn't matter. You want to know why you have the emotions about it, what those emotions are, and which ones are applicable in the moment, and which ones are coming from your past or your historical perception. And when you can analyze that emotional data and say, okay, this is about the here and now, and I'm feeling nervous, afraid, fearful, anxious, doubtful, elated, whatever, but some of that is from my own personal history, and some of that is from my experience. When you can say that this emotion is coming from this conscious here and now, and this emotion is coming from this historically, what typically is an unconscious pattern, then you have a much better shot at making the right judgment call. Because that's all any of us can do. And that's the thing. There's something called the ambiguity aversion, meaning we don't like ambiguity, or we don't like conflicting data, and we want to make it precise, and we want to know for sure. And I don't care whether it's the markets, or having a child, or getting married, or moving cross country, or buying a house. It's the future. And no matter what, it's always uncertain. We can't really know. So this book is only about making better judgment calls by understanding this emotional realm of data that your brain is using, whether you know it or like it or not. And so that's essentially, I wanted to lay out the science that proves that in the book. I wanted to take it to understanding the unconscious realm of emotions and what typically is going on for people. So an example is what I call the spectrum of fear. And this definitely applies to people who are traders and active investors. But you always hear fear and greed, fear and greed. It's my supposition that it's actually in the markets. It's not so much fear and greed, and there's research for this. It's a spectrum of fear, where on one hand, the spectrum is fear of losing money, or if you get behind that one level, or deeper one level to a more psychoanalytic fear of being wrong, actually, to the other end of the spectrum, which is fear of missing out. And most scenarios where we're tempted to scream, greed, 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 it's really, in reality, the fear of missing out. In the case of professionals, on money they could have had, should have had, did have, now want to give back, or even for the average person that pays attention to their 401k and makes a few changes a year. Let's say you did buy Apple stock this week even at 400 and almost, well, I know it was at 493 at one point, didn't make it over that 500, which by the way, there's a neurological explanation for why numbers like 100, 200, 500, etc. become resistance numbers in the market. Your brain actually processes them a split second faster, because 500 is easier for you to think about than 493 and 25 cents. It just takes a little bit more work. So I mean, it happens at this imperceptible level, but even numbers feel more comfortable. You don't recognize that that's happening, but that's part of the reason why even numbers, Dow 10,000, Dow 15,000, let's say we ever get there, actually have sort of this magnetic quality in the markets. And then, what was I talking about? Oh, fear of missing out. So there's actual decision research that shows what's called the fear of future regret. And the fear of future regret is what? I don't want to feel bad in the future, right? I don't want to make the wrong decision now. Well, in practicality, that's fear of missing out. For traders, active professional traders, that is, like I said before, well, I've been in this position, whether it's a stock or a future or gold or oil or whatever, I've been in it, I've been making money. The hardest decision is to know when to get out. Particularly, ironically, knowing when to get out when the position has worked. It's actually harder to deal for the professionals, and probably for the non-professionals, probably for all of us, to deal with the winners, because sort of no matter what you do with the winner, you put yourself into I coulda, shoulda, woulda. That's what the floor traders say. I coulda, shoulda, woulda, meaning I could have held it longer and it would have gone further. I should have gotten out of it sooner because it retraced and I gave back 20% of my money. I should have did this, I should have did that, coulda, woulda, shoulda. So ironically, because we've all been trying to set the emotion aside, and our brain's been trying to use emotion as a way to give us valid information to protect us. I believe in an evolutionary psychology point of view that emotions are meant to protect us at our core. We're just basically totally miseducated, at least in this culture, as to how to use them correctly. So they get convoluted into all of these other things, and this gets into a whole other story. But back to fear of losing on one hand, fear of missing out. If you just even know that whatever decision that you're making, whether it's a trading decision, an investing decision, or a different kind of decision, that fear of missing out, which is regret theory, has been shown to be the most motivating emotion that we all have. And for what it's worth, that men particularly have, being maybe a little bit more competitive. That's just the research, and don't shoot the messenger. But if you know that that's going to be operating, then you have half a chance of stepping back and saying, well, wait a minute, okay, where am I on this fear spectrum? And I lay the fear spectrum out in the book. And advice would just be saying, look, don't expect to be trying to get rid of the fear. I mean, it's a decision about the future, and you don't know what's going to happen. And you want to make the best decision, but there's no way you can have all the data. I mean, you can have a whole lot of data that'll give you a whole lot of good clues, but you can't know for sure, no matter what it is. So if you can then say, okay, I'm going to feel some amount of fear, anxiety, and doubt because it's just part of the situation of making a decision about the future, then you can say, okay, how much fear, anxiety, and doubt am I feeling? Why am I feeling it? What is about the here and now? What is about what I'm risking? And what may be in the back of our mind, and this is for this audience, I don't necessarily throw this word out, even though I know I've already said it here, but Roosevelt and I throw this word right out. What is the psychoanalytic version of what's going on in that fear of missing out? And is it, really that somewhere in the back of your mind, mom or dad is going to be saying, now why did you do that? Or why did you think that? Or that was the dumbest decision you've ever made. Or, that's just never going to work out. And we all have those voices in our head, which, by the way, very recent research shows that when we project what's going to happen in the future, what do we rely on? I mean, we all sort of know this, but literally in our brain, we rely on the same networks that work with memory. So if we're projecting what we think is going to happen if we make a certain decision, we look back to what's already happened, to what we think are similar decisions. So if you think about how repetitive patterns end up happening in our life, because naturally, the brain's being efficient to look backwards. I mean, from a network data point of view, and from a brain cell chemistry point of view. It doesn't mean that the past it has to be the future, but I mean, past is prologue for a reason, because the book is based on really trying to just take all of these veins of neuroscience that, as for those of you who are in academia, know that they don't, the different ivory towers don't necessarily talk to each other all that well. Now, they're getting much better at it. There's an integrated lab of judgment and decision making at Harvard. The woman who runs it is Jennifer Lerner. She says, oh, by the way, we skipped studying emotion for 60 years for some strange reason, but now we're back to studying emotion. So at the bottom line, the book is about emotional and social, but social is part of emotional. So the realm of emotional context in all your decisions, both the emotions that are relatively easy for you to get conscious of and the emotions that you might not be so conscious of. And changing the way you even think about emotion and making a commitment to do, at least for yourself, what I call emotion analytics as a way of clarifying your perception and then making a better judgment call. Because at the end of the day, all you can do is make a better judgment call. With that, I think I'll take a couple questions and then maybe we'll read a section. And we should at least talk about the ultimate goal being knowing the difference between impulse and intuition. But anybody willing to?
Now, you were talking about emotion. Well, I want to give you an example of, I think, November or December 2010. Meredith Whitney made a call on municipal bonds. And I look at this thing, and I'm reading the rebuttal was that municipal bonds had extremely low default rate at that time. And even if they went 10 or 20 times higher, it would still be very small, and that you would still get your, income. So that proved to be a terrible call. Where does emotion come in? That was a statistical thing. It was a 0.03 default. If you multiply it by 20, you're at 0.6. 0.6 is still a tiny default rate.
Right.
And realistically, that even if that happens, I mean, is the whole thing just going to implode?
Well, so think about what you're talking about. Meredith Whitney, for those of you who don't know, is relatively now well-known market commentator, and I actually heard her in person make that call in October at a conference. But what did you do with the information?
I bought municipal bonds. That's what I did.
No, but first what you did was you said, how much do I believe what this person said?
No, I looked at the rebuttal.
Well, okay, you looked at the rebuttal, and then you said, which one do I believe? Do I believe Meredith, or do I believe the rebuttal? So here's a good example, though, of where emotion was in your decision in a good way. You read the rebuttal, you had more confidence, which is an emotion, in that rebuttal.
Statistics, I had confidence, not in the rebuttal. It was all about the statistics.
But where did you learn to have confidence in statistics?
Well, I mean, the history of municipal bonds, default rate and so on, there's a history there. And why would something happen that would change that? That's my, I asked myself.
But all I'm saying is that it's true that if you didn't have confidence in your understanding of statistics, like literally, like if the neural networks in your brain that allows you to feel confidence didn't exist or they were damaged, because that's where the experiments have been done with people whose emotional centers of their brain have been disturbed, you would not have been able to have that confidence. You would have read Meredith Whitney, read the rebuttal, read Meredith Whitney, read the rebuttal, and gone, and you would have never been able to make the choice without that confidence in your knowledge of the statistics. Like, that's a fact. So you did it.
That's right. Because,
Did he make money?
But they didn't analyze the statistics. That's my point. The history the municipal bond market.
Which, those kinds of things happen all the time. I mean, people are making calls all the time, right? I mean, obviously there's a big industry making calls in the stock market. And obviously everybody's got to decide what, if they're active in the markets or the bond markets, they've got to make decisions about, which call do they believe in, which amount of data do they believe in, do they believe the analysis? I mean, you looked at the municipal bond market and said, this analysis is good, this makes sense to me, I'm going to go with that. You take another market, you look at the same analysis, and you came to it with a belief that the statistics in their analysis was good, and then you basically executed on your confidence in that set of data. If you didn't have confidence, you wouldn't have been able to make that decision. And that's where the point is, you can't make emotion. You can't make a decision without emotion.
So maybe he shouldn't have confidence in the statistics, but in himself. Otherwise, he would have made a better decision.
Well, he's got more confidence in himself than he realizes, or that he's sick.
History speaks for itself. I'm not gonna, I'm gonna go with the history. That's all.
So that says that you've got confidence in history, because there are kinds of things that happen all the time that have not happened in the past.
Right. Thank you.
That's true.
So,
But
Don, thank you for your question. Don.
In any decision, I mean, the way I look at it, there's always a possibility you're going to be right or wrong. You make the best judgment.
Right.
I think that the idea of fear and all that other stuff, you have to be comfortable within yourself. I mean, I do invest. I'm not the smartest guy in the room, believe me. And I know when I invest, I could be wrong. So what the hell is so difficult? The only thing is you want to be right more than you're wrong. Go to a poker game, right? You don't get the cards, things that you could be the smartest guy, you know everybody's cards. You still got to get the cards. Things still have to come to you. And there's going to be a time when you realize that you can't control anything. So when you go out and take a risk, get in your head. You could lose. And if you don't like losing, don't play.
Well, you made a very good point about poker, because poker is a great example where there are the absolute probabilities of the cards, but it's not necessarily how you win the game. You win the game by playing off what other people are playing on their cards, and that's true. That's certainly true in the markets. Certainly true in the markets, and true from a perception and judgment and decision making. But like you said, you get comfortable or don't get comfortable, you make a judgment call, and you're willing to roll the dice, and if you lose, you lose. So think what you've actually worked through your emotions about it. Like, you sort of know how you feel about it, as opposed to saying, oh my gosh, what do the numbers tell me? Where is the answer in the numbers? The numbers are a clue. I'm not denigrating the value of the statistics or the numbers. I'm just saying that they're incomplete. And as a culture, particularly on Wall Street, we've spent too much time focusing only on the numbers, trying to find the absolute precise answer in the numbers, and we need to put that back within the context of a qualitative human judgment, which, oh, by the way, qualitative human judgments are shown to be really good, and so I'll get to the intuition versus impulse. This is in the book. There was a long article in the New York Times a couple of years ago about hunches, and the U.S. military purposely training very high-level people in the U.S. military, and I know we've got one in the audience, to know how to count on their hunches. And I do think that's the ultimate goal of this endeavor, if you will, to know the difference between when you're feeling something that's intuitive, which is really unconscious pattern recognition or experiential learning that you've learned somewhere, valid intuition, that is, by the way, a relatively calm, I just know feeling. And when you're feeling something that's impulsive or compulsive, which is, oh my gosh, I gotta do something about this. I mean, not always, but I mean, that's the gross way to, I mean, obviously you've got an emergency right in front of you and someone's just been hurt, obviously you've got to do something about it, but outside of an emergency situation, knowing the difference between how it physically feels to you, which, by the way, I recently came back from the Society for Neuroeconomics, which is one of the societies that I go to. Neuroeconomics just means it's all the economists who decided they wanted to actually study the brain because they figured out the pure economic theory wasn't quite working, and they wanted to see what the brain does when it's making economic decisions. And one of the hottest topics this year was mind-body cognition, which basically just means we think with our whole bodies, meaning how we feel about something influences what we think about something, and which is essentially what I try to do in the book, is lay out the logic of that and then how to make it practical. I also put it in a fictional story to make it a little bit more interesting, which I'm happy to read a little bit from. Matt, I saw.
I recently read an article that defined the Dow Jones Industrials as an anachronism, that was saying that relying on 30 industrial stocks as a benchmark for the economy was nuts. And yet it's reported in the news, when the Dow goes up, we feel good. When the Dow goes down, we feel bad. Is there a benefit to having this arbitrary number defining the health of the economy?
Yeah. I mean, the reason they say it's an anachronism is because it doesn't necessarily reflect the most, active companies of the day. But I don't think having the Dow as something that people are so familiar with is necessarily a bad thing. I mean, that's my own personal opinion. If you care to look into it further, then you add to the S&P 500, and then you add to the NASDAQ, and even just those three numbers give you a sort of a much broader perspective. Or the NASDAQ 100, which has got the top tech companies in it. And, I mean, I do think it's fair to say, not that I should go here market prognosticating, but that when you look at what's going on with Google and Facebook and LinkedIn and all of the companies that, the high-tech and Apple, that there is potentially sort of a new paradigm coming, a sort of tech industrial revolution that we sort of expected back in the first tech bubble. And now I think maybe we are going to see it, but I don't want to be market prognosticator. When I am trading, I'm a very short-term trader. I trade the S&Ps. My average hold time used to be 3 minutes and 17 seconds. Although I do also think that you can make longer-term predictions. It just wasn't my specialty. Edgar.
The premise is emotions control or dictate what your behavior is. And if your behavior is not what you want it to be, if you want to change your behavior, you have to review your emotions. You've talked in the past about the King's Speech and how the speech therapist, changed the stuttering behavior of the king. Can you talk a little bit about that process?
I don't know if you could all hear him, but he was basically saying, Edgar has worked with me. He's a trader, if I can say that, and he's somewhat familiar with my work. But he's talked about how I've talked about the movie, The King's Speech, and the work that was done in that movie. And really what that speech therapist was doing was working directly with his emotions in a way that he was what, in the psychoanalytic world that I would come from, was called joining his emotions. Now, the first thing he did right off the bat was put him on the even level with him, right? He said, I'm going to call you, I can't remember what his first name was, but, Bertie, but he was really working with him on this emotional level, as opposed to, everybody else started to practice the speech, tell him what to do, intellectual. And what Edgar's referring to, it is really true, is there is so much power in allowing yourself to feel what you feel and handling it in a different way where you're not using your intellect to try to tell yourself to get over it. Where you're just saying, I'm anxious, nervous, annoyed, whatever the feeling is, and just put words to it. And my guess is a lot of you know this. What you often find when you just allow yourself to feel it, identify it, put a word to it, the feeling starts to dissipate or cannot be as compelling, right? Because you have done a little bit of putting it into data. You've done a little, you've taken some energy, I think that's what's really going on, is you've taken some energy where that feeling is trying to tell you something or it's left over from the past. in that Freudian, which in the book I explain how, I don't know if any of you are familiar with, well, I'm sure some of you are familiar with fractal geometry. They didn't teach fractal geometry when I was in high school. But I believe our psyches are fractal. Fractal is, like, for those of you who aren't familiar with it, broccoli, cauliflower, lungs, tree branches are fractal. Meaning, if you think about a head of broccoli, one tiny little stem looks very much like a stalk. And the stalks all put together look very much like a head. In other words, it's at a different scale, but it's called self-similar, different scaling. But self-similar repetition, there's a word I was getting in there. But I believe that our psyches are indeed fractal. And so we learn where we fit in the world, perceptions of ourselves, what we expect to get from the world, and unconsciously, back to this memory research and how we use our memory to project into the future, unconsciously we bring that expectation to any particular decision that we have to, judgment call we have to make about uncertainty that we are nervous about. We bring that old fractal, those patterns that we learned when we were young, to these decisions as an adult. And I think the same way that Benoit Mandelbrot and his group of mathematicians that have followed him and outlined now fractal geometry, it matches up, as far as I'm concerned, completely with Freud's transference and repetition compulsion, for what that's worth. But back to the King's speech, it's really just a different, at the end of the day, it's a different way of handling the emotion. It's like, it's there, some of it's relevant. It's reasonable to be afraid to give speech. Is the audience going to look at you like you're crazy? Are they going to, walk out? Or are they going to like it? It's not like some amount of fear, and that's one of the things we tend to forget. Some amount of fear, anxiety, and doubt is reasonable in most situations. And our brains actually say, and this has been shown, that a certain amount of fear is very, very valuable. Because think about it, think back to school. If you had no fear of failing the test, would you ever study? The fear worked for you. But because we weren't taught then to keep on, to first of all use it in any sort of systematic, organized way, we got this idea, and you can trace it back to part of the Greeks, where emotion became this bad thing and we had to be purely rational. And oh, by the way, Darwin, Einstein, Stephen Jobs, and now me in this book, all say you have to have emotion to be rational. And I think it's really at this point a scientific fact.
What's your view then on the accuracy and utility of folks like University of Michigan consumer sentiment surveys, which attempt to provide empirical measures to the emotional state of the economy?
Well, I think it's, I'm not saying that putting an empirical or numerical number on sentiment is an invalid way to go about it. In fact, I recommend that people do that. And so, but like with Michigan consumer sentiment, so what happens? It changes, right? Monthly it changes, and it can be very dependent on things that happened quite recently. I actually advocate to put a numerical or empirical, not really empirical, but a numerical framework in which to understand the degree of your own feelings and emotions. And if you're in the market, to actually do it for the market as a whole. So, in fact, it's one of the projects that I really want to work on. And I was with Bloomberg Friday night talking about, they were asking me, well, really, where did I want to take this? And I said, what I want to take it is the right qualitative envelope with the right logic, which I do think you can actually put some numbers on in order to just help you understand the depth and the scope around what we do as quantitative analysis in Wall Street.
Would you view it more as a leading or a lagging indicator, though?
Pardon?
Would you view it more as a leading or a lagging indicator?
Michigan consumer sentiment, or I think it's,
consumer sentiment in general, is it a response to the market, or is it a market response?
I think it's definitely response. I absolutely think it's definitely response. Because basically, when you think about people who are answering questions to Michigan consumer sentiment, they're looking at their own situation, or did their cousin lose their job, or did they're looking at things that they've seen and heard around them, and that's influencing how they feel, whether they know it or not, and then they're answering the questions about, they're taking how they feel right now and projecting it onto the future. It may or may not be true. They're probably not analyzing why they feel the way they do. But I believe that every one of us in every situation can analyze why we feel the way we do, and for our own selves, then improve our perception and improve our judgment.
Along the same lines, so you fully understand yourself.
Pardon?
Say you fully understand yourself, and you know.
Okay, so you fully understand.
How do you predict the psychology of the markets in general? How the collective emotions play on whether a stock goes up for no rational reason?
The question is, say you fully understand yourself, and basically how do you predict the market from doing that, right? With having that data.
The collective emotions.
I think, number one, you look at it from two perspectives. Is everyone that I'm thinking about like me or not like me? Well, so if you fully understand yourself, you have to assume everyone's not like you, because that's just not going to happen in this lifetime. And you also have to assume that not everyone's going to learn what I've laid out in this book in terms of, so you're able to say most other people are going to make certain kinds of mistakes that they've been making forever. So, for example, there'll be some point at which, and I don't know, it could be $520 or it could be $1,020, who knows. But there'll be some point at where a stock like Apple has what in the industry is referred to as a blow-off top. But you will know that that kind of thing's coming. And if you watch markets at all, you see it all the time. We get this really exponential move. When markets or stocks are moving in one direction and they're highly popular, sooner or later they get that exponential move out of nowhere, really quick, fast price action. By the way, as tape readers, what you learn to do is read the speed and rhythm of the thing. So how fast it's doing it makes a big, and how far it's moving. But you can assume that most people are going to be making mistakes. I mean, at the end of the day, most people are still going to be buying at the top and selling at the bottom, because they're not going to know themselves as well as you do, nor are they going to learn to understand their own perception and judgment by understanding their emotional context that they're bringing to it. But you can just ask yourself that question, just ask yourself. Like people say, well, what about all those quants I'm fighting against? What about all those computers I'm fighting against? Or what about all those banks I'm fighting against? I mean, it's been my experience today, and I've coached people who literally personally manage more than $1 billion, and I've coached plenty of people who manage $10,000, $15,000 on both ends of the spectrum. And every single one of them has told me that when they remember to step back and ask the question about the markets in terms of other people, they make better judgment calls. And that fits with that research. Oh, by the way, it was done by an electrical engineer at Caltech. I had a guy actually a guy that does manage $1.5 billion in what's in industry terms is discretionarily. In other words, he works for a hedge fund. They're partly systematic computer algorithmic hedge fund. They also have people that are portfolio managers. He has $1.5 billion to manage himself, and even I can't quite get my head around day trading $1.5 billion. But he tells me that when he just remembers to step back and say, what are the other guys doing? Who am I trading against? This is a basketball game. I mean, to him, this is a basketball game. Like, what's the offense and defense? What's happening now? He makes better decisions. And I just want to say one more thing about that. I had a floor trader, very successful in Chicago, went to the screen, couldn't trade when he was seeing the markets through the screen at all, had made, on the average, $2 to $3 million a year before he went to the screen, and then he had 6 kids. He was going broke. And I finally got him to take all that stuff off of the screens. He was a big basketball player. And imagine, as he was watching the prices move intraday, that it was offense and defense, and the ball was moving up and down the court, and just to see the way the prices would move as that basketball game. And he said, whenever I keep my mind in like I'm really just kind of watching a basketball game, I'm watching the plays unfold, I make better decisions than when I don't. All that does is give you anecdotal evidence to the Caltech study that said using theory of mind and understanding the markets as other people and rolling perception, it's individual anecdotal evidence that supports that research. So, I got lots of questions. I saw this hand first.
I think there are some important factors to support individual neuroscience. I don't think neuroscience just for your basic bone knowledge. It's some factors getting together to supporting your own neuroscience to judge all these. You need the statistical, you need a lot of study, you know, to be a neuroscience in the right direction for your relating with the perception or that. You need some knowledge to supporting your neuroscience in your brain.
An individual needs that?
Any common individual, it's a neuroscience. It's not just coming by itself. Supporting something to have your neuroscience going, link something together to go the right direction.
In other words, the individual, if the individual has a better understanding of the neuroscience.
I don't think the neuroscience is God's given to you. It's supporting to you have neuroscience to work together to get to the right direction in your human mind.
I think what you're saying is that neuroscience is a supporting tool in all of the veins of neuroscience.
Your login, your whatever, what would be the factors to go supporting that?
I'm not sure if you're making a statement or asking a question. I'm sorry, I'm just having trouble understanding her.
Neuroscience going all by yourself, all by itself. Neuroscience. I have to there's every step, buy and sell in the right time or that. You need some knowledge to do that.
Oh, besides neuroscience. In other words, so you're saying you need beyond neuroscience knowledge to know about buying and selling stocks.
Neuroscience, supporting to it, so you can.
Right. I mean, I think that's fair. I mean, I don't think that you should, listen to me give a lecture about emotions and decision making and know nothing about the stock market and then go out and buy stocks tomorrow. But what I do think is that you can understand, you can take the fact that a lot of neuroscience has shown that this understanding the market as other people is a place, a jumping off point that you can say, wait a minute, if that's true, that the market really is just people's perception and the numbers, that's why the numbers change all the time, because we think it's worth this one day and other guys think it's worth something else tomorrow. That it doesn't have to be the complete mathematical mystery that it is to the average person. It doesn't have to be something that you can't do something with on your own once you realize that fundamentally, whether that neuroscience study showed that it was theory of mind and other people or not, it is. I mean, it's only a perception. In 2008, when we were all going to hell in a handbasket, it wasn't that those complex underlying CDOs and CDSs were literally worth nothing, but the market was acting like they were worth nothing. I mean, they weren't worth as much as they thought they were in 2006, but they weren't worth nothing in 2008. It was like, the way the market was acting was as if everyone who had a mortgage anywhere was going to default on their house. Well, that was that was an overreaction. It wasn't a reality. But my point, and that kind of stuff is really scary to the average person. Like, I mean, how do I understand all this complex mathematical instruments that go on in the market, and gold and oil, and never mind, CDSs and CDOs are bad enough. But just knowing that there's research that validates that it is a human perception game, which we all know if we step back. But anyway, like poker is a human perception game, should be able to give you a baseline that says, hey, wait a minute, maybe I do want to, whether you read my book or not, but take on looking at it a little bit differently and maybe take on responsibility for some of my own money, because it doesn't have to be a complete mathematical mystery. And there are psychological advantages you can create. Certainly, the active trader can create an advantage if they know the basics of the market, can create an edge for themselves out of psychology. I see Bill pointing to Linda.
Oh, okay. You kind of answered my question, or people kind of asked it, but to further define what you were saying before about emotion, let's say you're aware that the emotions you're feeling are from the past versus the present, or you make a distinction of both. What do you do with that? Okay, I know it's coming from the past, but is it valid? Is it because I'm protecting myself from past experience? I've learned X. Should I do Y because of present emotion? And also, I'd just like to ask your distinction between neuroscience and psychology, because they seem so closely aligned but separate, but I just kind of separate question.
Okay, so there's really two questions there. If you know that what you're feeling is from the past, what do you do with that? And the distinction between neuroscience and psychology. So if you know that what you're feeling is from the past, the traditional, frankly, Freudian